All right, today we are going to have some fun as we are talking about policy loans. First, we are going to answer some commonly asked questions that we recently received and we hear a lot, and then we'll go through an example of how policy loans work. So let's jump on into the questions and have some fun. Question number one, what is the maximum loan that I can take from a whole life insurance policy? The maximum loan that you can take is typically 90 to 95% of whatever your available cash value is. Your cash value determines how much you can borrow against your whole life insurance policy. Question number two, how many loans can I take? Is there a limit to the number of loans I can take against a whole life insurance policy? No. When you take loans against a policy, the loan balance functions similar to a line of credit. Meaning when I take a loan, so let's say I've got $100,000 outstanding in a policy loan. If I borrow another $50,000, what happens is my loan balance is now $150,000 and interest will accrue on that $150,000. So there's no limit to the number of loans I can take against my whole life insurance policy because whenever I take additional loans, it just adds to the balance. The same is true when I make payments against my policy loans or toward my policy loan. What happens is the loan balance then shrinks. Question number three, do I have to pay loans back? So no, generally you do not have to repay loans. You can even get away without paying any loan interest. However, if you're in a position where you have taken the maximum loan against your policy and you're not paying the loan interest and you're not making any premium payments, that could be a case where at a minimum, you have to pay the loan interest. Because what happens if the loan interest exceeds the interest earned on the policy, which is a combination of your guaranteed interest and dividends, if the loan interest exceeds the earnings on the policy could end up lapsing. And that can be a problem, especially if we've taken loans in excess of what we've paid into the policy, meaning I paid in $100,000, the cash value is worth $200,000, I've loaned $200,000, and then it lapses. That could result in an ugly taxable event. So generally, we do not have to make loan payments. We don't have to repay a loan. It's very easy to set up a policy where we take loans and never pay anything back. But if we take the maximum amount out and we don't have awareness that it could lapse, that would be a situation where you're going to receive a notice from the insurance company saying you need to pay this, otherwise the policy will lapse. And that could also result in tax trouble. So some additional information there that is definitely beneficial to be aware of. Question number four, how soon can I take a policy loan? So you can borrow against your whole life insurance policy anytime. Whatever you have in cash value determines the amount you can borrow. The earliest you can borrow is typically 10 business days after starting a policy. So if you start a policy, you add a big old lump sum into your PUA rider and you've got a lot of cash value you can access. You can access it typically 10 business days after starting the policy. Some companies allow you to take those loans a little bit earlier than 10 business days as well. Now, one thing I like to add here is I would ask yourself the question, does it make sense to take loans in the first year? Because remember, when we look at the policy performance, we're always going to be negative in the first year. Now, it could still make sense, and this is why looking at the numbers is so valuable, but we do want to make sure we have awareness of the fact that we are negative in the first year, and if we borrow, now we're paying interest to the insurance company as well. So we definitely like to point this piece out and make sure that everyone is aware. Question number five, what are the repayment terms? So the repayment terms with a policy loan are completely up to you. There are two main approaches you can take. One, you can treat it like a personal line of credit, meaning that you can log onto your online portal and just throw money at the loan principal anytime you'd like. Now, you will be billed for the loan interest on your policy anniversary date, which is a fancy word for the premium due date, and when you'll receive your policy anniversary statement, the statement with the cash value, death benefit figures, everything. But that is when the company will bill you for any loan interest. However, back to the question, what are the repayment terms? There really aren't any terms. The insurance company does not say, here are the terms that you must repay the loan back by. It's up to you, because remember, you can get away without even paying anything toward that loan. So you can treat it like a personal line of credit where you just throw money at the principal at your leisure. Or if you'd like to take a disciplined approach, you can set up auto payments, where you can set up automatic drafts from your bank account to go to the insurance company, which will pay down your loan. And you can do that and then throw money at the loan principal as well. So you've got control of that, which is very, very nice. A lot of people who are actively using their policies like that control feature a lot because they don't have to worry about being committed to a large monthly payment or anything that will cause them any type of financial stress. Question number 6, are loans taxable? No. When you take policy loans, they are generally not taxable. When taxes can occur with a policy loan is 1, if your policy is a MEC, a modified endowment contract. That's one example. Another example is if you have a non-MEC policy, you take loans, they're not taxed at the time, but then the policy lapses. If a policy lapses with a large loan balance outstanding, that could result in a taxable event, which we definitely want to have awareness around that. Question number 7, can you provide an overview of how loans work? Yes, we will do that right now, and we'll use some visuals for this one. So when explaining policy loans, I like to start with real estate. And the reason why is because when you look at a life insurance policy and how loans work with that policy, it's very similar to real estate. So let's pretend for a moment that you own a piece of property that's appreciating at 5% like clockwork every single year. And first we'll pretend that you don't have any loans outstanding and the value of that property is $1 million. So you've got a $1 million piece of real estate compounding at 5%. What I mean when I say that is that we're assuming the fair market value of your real estate goes up by 5% every single year, no matter what. We'll pretend for the sake of this example that is guaranteed. So at 5% over 10 years, the value will be about 1.5 million. We're assuming compounding at 5% in this example. And again, this is assuming you own it free and clear and never borrow against the property. Okay, great. Now, what if you decide to take a loan against the property? Well, today, your property is valued at $1 million. Let's pretend you take a loan of $500,000 against the property. That means you have about $500,000 in equity remaining, additional equity you can access if you'd like. And we'll pretend in this example that you pay that $500,000 loan back within the next 10 years. When you paid the loan back, interest went to the bank. However, if it's paid back in 10 years, what's the value? $1.5 million. While you had that $500,000 loan outstanding, you continued to earn 5% on what? Did you earn it on the entire property value or only the remaining equity? The entire property value. Think of it this way. If you were to search for homes for sale on Zillow, you're going to see the fair market value of those homes. It doesn't matter if there's a mortgage outstanding or not. Whatever the value is or the sale price, that's the sale price. So you'll continue to receive that appreciation on the entire asset. So how is this like a life insurance policy? Well, if we do the same thing, but with a life insurance policy, we'll assume that it's compounding at 5%. Let's pretend you've got cash value of $1 million. Your death benefit is $2 million. In 10 years, you'd see cash value of about $1.5 million. The death benefit will also appreciate in an example like this. Now you've got $3 million. Let's look at the same policy, but with loans outstanding. So before we take a loan, cash value $1 million, death benefit $2 million. We take a policy loan of $500,000. When you borrow against your insurance policy, your death benefit will be collateralized dollar for dollar. Your equity, which is available cash value, is now $500,000. If you have $1 million in cash value and you borrow $500,000, the equity is again additional cash value that you can access for more opportunities or really whatever you'd like. Then let's assume we pay the loan back in 10 years. We will pay interest not to the bank in this example. To who? To the insurance company. Okay. Now, when we pay that loan back, what happens? Well, your cash value and death benefit are 100% restored to exactly what they would have been as if you never touched it in the first place. So your entire asset, all of your cash value, continues to compound even though you've borrowed against the policy. That's really where a lot of individuals are attracted to whole life insurance for the loan feature. We like to refer to this as a personal line of credit. Want to see an example with numbers? Let's wrap up with that. So here we go. What we've got here on the left is a policy with no loans. We're just pumping money in and letting it sit and grow. A lot of times when you see someone who is using real estate and they're interested in a whole life insurance policy, what they're not interested in is making payments for a long period of time. Just from my experience and working with a lot of individuals with real estate, it's a one-time purchase and then I own it. Maybe I have a mortgage and I'm paying that mortgage off, but I don't have to continue to fund real estate and continuously fund the equity. It's a one and done, and then I can look at the next project. So with a policy, the idea of making payments for a long time, a lot of times is not attractive to folks. So what we can do, and often do, is set up a policy where we fund it for a short period of time. Here we've got 5 years. Sometimes it's 3 years, sometimes it's 10 years. It's really up to the individual, but we'll customize it so we can fund it for a short period of time. Then we've got the cash value. Remember, this is our equity that we can access. And then we have the net death benefit, which when we borrow, that will be reduced dollar for dollar. You'll see that here. The annual compounding is just what the cash value is growing by year over year. Worst years of a whole life insurance policy, typically the first and second year. It's always the first year, and the second year is typically not that great either. So on the left, we've got growth. We want to look at this because when we take out loans, we can see what the impact of policy loans are. So through year 5, is there any difference in value here? No. Cash value and death benefits are exactly the same. Okay. Year 3, or not year 3, year 6, what happens? First column in red, we take a policy loan of $300,000. When we borrow, what happens to your cash value? You can call it equity to compare it to real estate, and your death benefit. Cash value drops by about $300,000. Here it dropped by $314,000. It dropped by the loan plus this number, the annual interest we see billed for the next year. The death benefit dropped by $300,000, dollar for dollar. Now in this example, we've got loan interest that is billed, but then in purple, that represents what you're paying out of pocket. So in this particular example, we're looking to pay the interest annually and then make loan principal payments of $30,000 per year. You don't have to do it this way. The purpose of this exercise is to model, if I pay this loan back gradually, what are my values when the loan is repaid? Here we go. Just about $800,000 at year 16 in this example. Now compare that with what you've got on the left. Just about $800,000. The death benefit is the same as well. So everything is 100% restored. The last step we would take in a case like this, if we really wanted to crunch the numbers, is see what am I paying in interest each year, which is right here, and then compare that with what the policy is growing by. Because remember, this growth is occurring on your entire cash value, even though we only see this in equity. You're still compounding on everything. So we can look at them side by side and see, am I gaining more or am I paying more? And if you want to get really fancy, what you can do is create another column here that gives you the total gains, and then another column here that shows you the total interest you've paid to the insurance company. So you can see what are my total gains compared to the total interest I've paid. Not everybody likes to do that. Some people do, but it's pretty neat when you crunch the numbers. So I hope you enjoyed this video. Please hit the like button and subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you If you have any questions, please leave them in the comments below. And as always, I hope this helps.